Let's bring in Solus Alternative Asset Management's Dan Greenhaus joining us now. I mean, you made the argument that you think the Fed absolutely should cut in September, and maybe they already should have.
Yeah, that's a correct characterization. I would take issue with my good friend Steve Leisman in how he frames some of this. And a lot of people do this. They talk about, they frame it as in the Trump appointees think one way and everyone else thinks another. And I don't think that's fair. I'm not a Trump appointee, and I've been making the case for some time that some rate reductions are in order. Neil Dutta, not a Trump appointee, has been making the case for some rate reductions. So I reject the political motive here. There are.
Well, I mean, it's inescapable that both Waller and Bowman, who were appointed by President Trump, have come out publicly and urged for rate cuts.
And I don't mean to suggest.
I don't think Steve's making a political comment in suggesting that is the truth.
Yeah, I don't mean to suggest that he's making a political comment. I mean, the description of them suggests that as Trump appointees, they might be wanting to do the administration's bidding. And I'm not saying Steve was saying that. I'm saying there's a general view out there that, of course, the Trump appointees want rate reductions. And all I'm saying is,
based on what they've said themselves.
As in terms of kowtowing to the administration?
Well, I'm just saying Waller and Bowman have made the case publicly they want rate cuts.
That's right, and I'm saying Waller's case in particular for rate reductions is grounded in sound, legitimate economic thought and arguments. I'm making a semantic argument. I don't like that they get characterized as the Trump appointees favoring rate reductions. There is a solid case for reducing rates by someone who was appointed by Trump or someone who was not appointed by Trump.
What's the most solid case for doing so right now?
Clearly, the labor market is slowing down. Outside of what we'll call tariff-induced inflation, which I've been arguing for some time, and I think I'm not alone, is, for lack of a better word, one-time in nature. And I understand you want to be careful that this doesn't seep into broader inflation expectations and affect how the consumer and society views things more generally.
Job growth slowing is different than job losses picking up.
Sure, but I don't need job losses to justify rate reductions. I think the rate right now is modestly restrictive, but maybe even a little bit more than modestly restrictive.
That's fair. I think the Fed chair has said as much.
So we agree. And so I think what we're talking about is, I think you could justify, let's say, 2 rate reductions this year to try to normalize policy and get it back into a neutral plane. And from an investor standpoint, which is ultimately what we're trying to do here, that would be a positive outcome. Not because rates are lower, but because the restrictiveness has been removed. I'm sorry, not because rates are lower, therefore stocks must go higher, but the damage that perhaps modestly restrictive rates are doing to the economy and eventually corporate profits would be reduced.
The pool of prospective Fed chairs is growing. Obviously, that's why we just had the update with Steve. Is there somebody on the list now of the 8 that he counted that would be the most, quote unquote, market friendly?
I think for a variety of reasons, Christopher Waller at this point is probably, based on my conversations with people around the street, Christopher Waller is probably the quote-unquote favorite. He has the sterling economic credentials. He has been making the case for rate reductions, which on balance investors prefer, lower rates better than higher rates, and has been doing so grounded again in sound thought and theory, and is not viewed as someone who is in bed with the administration. To counter it with someone, not to pick on her, but if perhaps tomorrow we announced Judy Shelton was the head of the Federal Reserve, that would carry, from an investor standpoint, more political weight, so to speak, than someone like Chris Waller.
Now, how reliant do you feel like the market's going to be on rate cuts to have a sizable move between now and the end of the year?
I don't think and I've been of this view for some time, tweaking rates, every time I'm on with someone and we talk about rates, they go, oh, who cares about 25 basis points? And that comment is made jokingly, but it is true. 25, 50 basis points doesn't really matter. It's the direction of travel, of course, that matters. So with that said, if you begin the process of reducing rates to take those tail risk outcomes off the table, so to speak, or at least reduce the probabilities of those tail risk outcomes, that's positive for risk assets, all else equal, and ultimately would be viewed positively by markets.
I know it's positive for risk assets, but are they necessary for risk assets?
No, I have not thought for a year or two that rate cuts were necessary. First of all, you've got the AI train right now driving the broader landscape, from the AI names on down through Eaton, Vernova, et cetera, et cetera. That is largely speaking rate independent, although some of the CapEx that's going to be necessary and the fundraising that's going to be necessary going forward, since we can't fund all this out of free cash flow, will be done at lower rates, hopefully. And so that's a positive. But that train rolls on nonetheless. And to the extent that rates are a problem for the consumer, particularly particularly the lower income consumer, and we have seen very little evidence of that. Lower rates are a positive, and so maybe you'll start to see some broadening out, assuming the economy holds in. So I think again, I don't know if it's enough for a substantial rally, but I don't think it's necessary, but it is nice to have.